Your bank pays you pennies in interest, yet somehow builds marble towers downtown. Curious, isn't it? Someone is quite clearly profiting handsomely, and I regret to report it isn't you. Today I shall reveal exactly how banks make money off you. First, a correction. A bank isn't a vault that stores your cash. It's a business, and you're not really the customer, you're the supplier. Your deposits are the raw material, and the bank turns that material into serious profit. How much profit? American banks alone pull in well over $200 billion a year. That money doesn't appear by magic. A big slice of it comes from ordinary people like you, one small charge at a time. Now then, once you see the machinery, you can't unsee it. And, rather marvelously, you can flip it to your advantage. Stay with me, because the fix at the end is frightfully simple and worth real money to you. There are three big engines inside every bank: the interest spread, the fee machine, and the investment desk. We'll open up each one, see exactly how it feeds on your account, and then learn how to starve it. Let's begin. Engine number 1, the interest spread. This is the heart of the whole business. You deposit money. The bank pays you a tiny rate of interest for the privilege. Then it lends that same money out at a much higher rate. Picture a seesaw. On your side, the savings rate, often barely above zero. On the bank's side, mortgages, car loans, and credit cards charging many times more. The gap between those two numbers is called the net interest margin. And what a gap it is. For years, big banks paid savers a ghastly 0.01% while charging 20% or more on credit cards. The same dollar earning them 2,000 times what it earned you. So when you leave $5,000 sitting in a basic checking account, you might earn 50 cents a year. The bank can lend against that money and earn hundreds. You take the risk of inflation. They take the profit. Here's the part most people never learn. Your money isn't sitting in a vault with your name on it. Banks keep only a fraction of deposits on hand. The rest is out working, lent to your neighbor's mortgage or a business loan. That's called fractional reserve banking, and it's perfectly legal. It's how the whole system works. Your balance on the app is really a promise, an IOU. The bank promises to pay you back whenever you ask. Usually, it can. Before you panic, don't. In America, FDIC insurance protects your deposits up to $250,000 per bank, per depositor. Your money is safe. The point isn't fear. The point is understanding whose money is doing the work. Yours. Engine number 2, the fee machine. If the interest spread is the bank's main course, fees are the dessert trolley, and my word, do they go back for seconds. Overdrafts, maintenance charges, ATM fees, each one small, together billions. Take the overdraft fee. Spend a few dollars more than you have, and the bank covers it, then charges you, often around $35 for the favor. Banks have collected billions a year this way, mostly from people already short on cash. Its evil twin is the NSF fee, non-sufficient funds. The bank bounces your payment and charges you anyway. You get the fee and the embarrassment. Some banks even reordered transactions to trigger more of them. Regulators have been cracking down. Then there's the monthly maintenance fee, paying rent on your own money. Miss a minimum balance and many accounts charge $10 or $15 a month. That's well over $100 a year for the privilege of being a customer. ATM fees are a double dip. Use a machine outside your bank's network and the machine's owner charges you. Then your own bank often adds a second charge on top, $5 or so, just to access your own cash. And here's the invisible one, interchange. Every time you swipe your card, the merchant pays a small percentage to the banks behind that transaction. You never see it, but it's baked into prices everywhere, billions collected one tap at a time. I dare say you're noticing a theme. None of these fees ruin you in one go, they nibble. A frightfully polite mugging, repeated monthly. The average household loses hundreds of dollars a year to bank fees without ever really noticing. Engine number 3, the investment desk. Banks don't lend out every spare dollar. They also park huge piles of deposits in safe investments, government treasuries, bonds and other securities, earning steady interest on money that, again, started out as yours. On top of that, banks sell products. wealth management, insurance, financial planning, premium credit cards. Walk into a branch to deposit a check and you may walk out with a sales pitch. Every product carries its own fees and commissions. Now, let's be terribly fair for a moment. Banks aren't villains twirling moustaches in the boardroom. They provide real services, safety, payments, loans that build homes and businesses. This is simply a business model, a jolly effective one. But a business model has incentives. The bank earns more when you stay in low-interest accounts, carry credit card balances, and shrug at fees. It earns less when you pay attention, which tells you exactly what your strategy should be. Add it all up, the spread on your deposits, the fees on your slip-ups, the interchange on your swipes, and the products in the lobby. 4 quiet revenue streams, all flowing from one source, you. Now for the proof. Remember the 0.01% era. For years after 2008, the biggest banks paid savers almost literally nothing, while their credit card arms charged 20% and up. That wasn't an accident. The wider the gap, the bigger the profit. And when fee hunger goes too far, you get Wells Fargo. Between roughly 2002 and 2016, employees under intense sales pressure opened millions of accounts customers never asked for. The bank paid billions in fines and settlements. A genuine scandal, fully documented. Why did it happen? Because accounts mean fees, and fees mean bonuses. The incentive machine ran rather too well. I shan't pretend every bank behaves that way, most don't, but the lesson stands. Banks chase fees the way bloodhounds chase sense. Here's the upside hiding in all this. If the bank's profit comes from your inattention, then your attention is literally worth money. A few small moves can shift hundreds of dollars a year from their side of the seesaw back to yours. So how do you flip the model? Step 1. Move your savings to a high-yield savings account. Online banks routinely pay many times the big bank rate. Rates change, so compare before you move, but the gap is usually enormous. Step 2. Refuse to pay fees. Pick accounts with no monthly maintenance charge. Turn off overdraft coverage so a purchase simply declines instead of costing $35, and stick to in-network ATMs. Fees are optional once you decide they are. Step 3. Never carry a credit card balance if you can help it. That 20+% interest is the richest engine the bank owns, and you're the fuel. Pay the full statement balance, and the swipe rewards become genuinely free money. Step 4. Once a year, hold a little audit. 10 minutes, 1 cup of tea. Check what your accounts pay you, what they charge you, and whether a better option exists. Banks count on inertia. Make a habit of disappointing them. And do remember, keep your money inside FDIC insured accounts, and it's protected up to $250,000. You needn't stuff the mattress. Use the system, my dear viewer. Just stop letting the system use you. Quite liberating, really. None of this requires wealth or genius. It requires noticing. The person earning real interest on their savings isn't smarter than the person earning nothing. They just looked once. This week, you look. That's the whole assignment. Now then, the recap, served with tea. Banks profit 3 ways: the interest spread between what they pay you and charge borrowers, an entire buffet of fees, and investing your deposits while selling you products. Splendid for them. Until today. Your money isn't in a vault, it's out working, earning the bank a spread. Fractional reserve banking, perfectly normal, fully insured up to the FDIC limit. The only question is whether your money works harder for them or for you. And your counter moves, high-yield savings, instead of nearly nothing, 0 tolerance for fees, never feeding the credit card interest machine, and a 10-minute audit once a year. Small moves repeated that quietly redirect hundreds of dollars back into your pocket. One more thing. This is education, not financial advice. Rates, fees, and limits change, so always check current numbers before you move money. But the engine I've shown you today? That's been running the same way for a very long time. Now, a question for the comments. What's the most outrageous bank fee you've ever been charged? Do share, one finds them fascinating. Then like this video, subscribe for one splendid explanation at a time, and share it with a friend. Cheerio.